Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So, hard to believe, but the third quarter has come to an end, and September ended pretty well. The markets were up. Dow closed over 27,000. It was, looking pretty good there, except for the last couple of days. And so as soon as we started into the month of October, we got a couple pieces of data that were, spread in the media as being wholly negative, and it's caused about an 800-point drop in the Dow over the last 2 days. So one of those pieces of data has to do with the ISM Manufacturers Survey. Now, this is not 100% data. It's a survey, so it can be fuzzy sometimes. But this survey, when the reading gets below 50, it doesn't have to, but it can be an indication of a slowing economy. And for the last 2 months, the reading has been below 50. It's, 47 or so right now. So is that a bad thing? Are we headed to a recession, as we've been hearing practically every day for the last 2.5 years? Well, I would ask that people consider a couple of other facts. So one, inventories are up. So companies that purchase stuff that is manufactured are basically have been increasing their inventories. And some have argued that that's because of the tariffs and the, quote, trade war. And so the more inventory that could be accumulated prior to tariffs, the more profit a company could make when they sold those goods because they didn't have to import them. The second piece of data that has me not so worried about the ISM survey is personal consumption. So in 2019, personal consumption is up 8.7% over last year. That's pretty good. And so when you think about it, one, the ISM data or report, it's a survey. It's not raw data. It's data collected about people's opinions with some data points thrown in. Two, so when we're trying to figure out how do we read that data, we have to look at the fact that, well, yeah, inventories are high, simply in what looks to be because of the tariffs and some accumulation that was going on to try to, stay away from the tariffs. And then three, we have personal consumption being up. So at some point, that personal consumption is going to eat into the inventories, which should then lead to more manufacturing. The second piece of data that came out, it was just a puzzling headline. So the ADP employment data came out, and it reported that 145,000 jobs were added, and that was 20,000, I think, more than what had been estimated. And the headline said, job gains are slowing. Really? So the experts thought there would be 120,000 jobs. We got over 140,000 jobs, and we had to paint the picture of, well, but so far this year, the average number of jobs per month added has been less than the average number in 2018. And that's absolutely a fact. And the reason that we think that is the case, it goes back to basically the number of job openings that exist in the United States. So there was, since 2017, there's been a substantial increase in the number of open jobs in the United States. So jobs that got created but didn't necessarily get filled. So starting in 2017, we had about 5.5 million unfilled jobs. And as of the most recent report, we have about 7.2 million unfilled jobs. So if you think about it, and I've said this before, but if you're an employer, are you really eager to create a new job when you're having a hard time filling the open jobs that you have right now? And that's what we think is causing sort of a drag on this job creation number. It's not because the economy's slowing. It's because we have too many open jobs and not enough skilled people to fill them. So the peak of the job openings was about 7.6 million, a little over that. So it has come down in the last couple of months from 7.6 down to 7.2. And if we see that number continue to fall, then that's when we would expect to see, the number of new jobs created start to get back up towards the 200,000 mark. So the last thing I wanted to talk about today, and wanted to, that might be a strong way of phrasing it. I don't want to talk about this, but impeachment. So a lot of people have asked me, oh my gosh, Todd, if President Trump is impeached, is that the end? Should we be worried about the stock market and the economy? And so first off, we have to look at what is the likelihood that it actually happens. So the House is doing their impeachment inquiry or investigation or whatever they call it, but they're doing it. There will at some point likely be a vote, and let's assume that vote goes, it's only a simple majority vote, so let's assume that vote goes, yes, we think we should impeach him. So then that recommendation goes to the Senate, and there's a trial. Now in the Senate, it's not a majority rule to impeach President Trump, it's a 2/3 rule. So there would have to be 2/3 of all sitting senators would have to vote in favor of impeachment. Now, since the Republicans control the Senate, that doesn't seem likely, but let's just go with it. Let's just say that it does happen and President Trump is impeached sometime between now and the election. What that means is that we now have President Mike Pence. And while some people, may not like that either, that doesn't mean that any bills that President Trump wouldn't sign, that Mike Pence is likely to sign. So it's really not a big change for the economy or the stock markets. It certainly causes uncertainty. I mean, impeachment is a pretty severe act. It's unsettling to a lot of people. It causes a lot of angst and animosity. But if you think about what likely happens, so it's not likely that the Senate will get a 2/3 majority, but if they do, a Republican is still going to be in the White House. So any bills that get passed by Congress that Trump would have signed would still likely get signed by Mike Pence. And any bills that wouldn't have been signed will likely not be signed by Mike Pence. So nothing much changes there. So we'll keep an eye on it, but it doesn't really have a real tangible impact on the economy or on the long-term stock market. It certainly can have an impact over the short term as people get afraid, as we sort of see volatile days like we have the last couple of days. But short-term volatility is not an indication of some sort of a fundamental problem. And I know I may sound like a broken record here because I've been saying this a lot, but I sort of have to, because the media seems to take everything, even if it's like the employment report where more jobs were created than had been expected, and they spun it into, well, it's a negative because we're not creating as many jobs as we had last year. Nothing seems to be positive. There is no news that comes out that the media will just simply report. So I'm telling you that I'm not overly concerned about this impeachment hearing or inquiry or investigation or whatever we're calling it. It's going to run its course, but it doesn't have any real meaningful impact on our economy, and over the long term shouldn't have any impact on the markets. Nor am I overly concerned about the manufacturers survey. It is a data point, but there's many more data points that still point to a positive, accelerating economy. And so we're not overly concerned. But this kind of daily monitoring is what we think everybody should be doing. And if you're not doing it yourself, then you might want to consider hiring somebody like us to do it for you. So that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back next week with another Uncommon Sense update. Thanks for watching. If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.